Welcome to The Explainer. Today, we're tackling two topics in financial accounting and reporting that just love to pop up as trick questions on the LCPA: trademarks and startup costs. But don't worry, we're going to break them down with some brain hacks so this stuff actually sticks with you. All right, let's just dive right in. Imagine you're starting your dream business. You paid a designer for a killer new logo, and you've spent a bunch of money on legal fees just to get everything set up. Now, your gut is probably telling you, hey, these are investments, right? These are assets. Well, when it comes to the official accounting rules, it's not quite that simple. First things first, let's talk about the identity of your business, your trademark. I mean, it's the face of your company, but how you account for it is a classic trap that a lot of people fall for on the exam. So, what even is a trademark in accounting language? Well, it's what we call an identifiable intangible asset. Basically, you can't physically touch it, but it has real, distinct value that's separate from everything else in the business. Okay, here's the first brain hack you need to remember. In the Philippines, under Republic Act 8293, you might want to jot that down, a trademark registration is good for 10 years. But, and this is the absolute key, you can renew it for 10 years over and over and over again. Pretty much forever, with very little cost. Because it can basically last forever, we classify a trademark as an intangible asset with an indefinite useful life. And that one word, indefinite, changes the entire game. You see, an asset with a finite life, like a patent, you write it down over time. That's called amortization. But an indefinite life asset? Oh no, it plays by a completely different set of rules. So the most important point here is this. You do not amortize a trademark, period. Instead, you have to perform what's called an impairment test at least once a year. So think of amortization like a slow, predictable countdown. For a trademark, it's more like giving it an annual health checkup to see if it's lost any of its power or value. All right, let's switch gears to this second big trap. All that money you burn just getting your business off the ground. These are your organizational costs, your pre-operating costs, basically the Insta expense. And again, that gut feeling kicks in. You're thinking, I spent all this money to create future value, so it has to be an asset that I can write off over a few years. It just feels like an investment, right? But the accounting standards on this are super, super strict. So what really falls under this big umbrella of startup costs? Well, you're thinking about all those initial costs just to become a legal company. You know, the one-time expenses to get the whole thing running. It also covers what we call pre-operating costs, things like the expenses you have when you're launching a brand new product or maybe opening up shop in a totally new city. And yep, this even includes all those necessary evils, like the legal fees and other official fees you pay just to get organized and recognized as a legal entity. All of that gets lumped into startup costs. And the rule for all of these costs is simple. It's direct, and there are absolutely no exceptions. You recognize them as an expense on your income statement immediately, the moment you spend the money. No capitalizing, no amortizing. It hits your profits right away. And look, this isn't just a friendly suggestion, it's a hard rule from IS 38. The list is crystal clear. Startup costs, training your new staff, all your advertising, even the costs of moving your business to a new location, all of it gets expensed as it happens. They are not assets. End of story. So you're probably asking, why do we have these rules that seem to go against our common sense? Well, understanding the why is the best brain hack of all, because it's what makes the rule actually stick in your brain for the long term. For startup costs, it all boils down to one word: certainty. I mean, the standard basically says that even though you're spending money hoping for future profits, you haven't actually created a separate identifiable asset. The link between that initial spending and future cash flow is just too fuzzy, too uncertain to reliably put on the balance sheet. And for trademarks, the logic is even more straightforward. Think about it. Amortization is spreading an asset's cost over its useful life. But if the useful life is indefinite, if it could literally last forever, what number would you even divide by? It just doesn't make any logical sense. So we do the health checkup instead, the impairment test. Okay, let's boil all this down into a super clear, easy-to-scan format for your final review. It's screenshot time, people. Here's your cheat sheet for trademarks. Number 1, it has an indefinite life, because you can renew it every 10 years. Number 2, that means absolutely no amortization. And number 3, instead, you test it for impairment at least once a year. Got it? Good. And for startup costs, the rule is even simpler.
It doesn't matter if it's legal, pre-opening, or organizational fees. You do not capitalize them. You expense them immediately in the period they happen. That's it.
And there you have it, our quick explainer on these two really important FAR topics. Now you have the rules, and better yet, you have the logic behind them. But that does leave us with a bigger question for your future as a CPA. The rules tell you how to account for it, but how do you measure the true value of these invisible assets? That's a whole other level of the game. Keep that in mind as you study. You've totally got this.